Chapter 4. Non-Life Insurance. Chapter Objectives. Dear learners, after completing this chapter, you should be able to understand fire insurance, explain marine insurance, describe fidelity guarantee insurance, explain theft insurance, describe automobile insurance, understand aviation insurance, describe workers' compensation insurance, understand public liability insurance. 4.1. Introduction. Non-life insurance consists of property and liability insurance that are designed to provide protection against losses resulting from damage or loss of property and losses resulting from legal liability. 4.2. Property insurance. Property may be exposed to a wide range of perils: fire, theft, perils of the sea, and damage by persons, whether accidental or carelessness. 4.2.1. Fire insurance. Fire insurance is designed to indemnify the insured for loss of, or damage to, buildings and personal property by fire, lightning, windstorm, hail, explosion, and a vast array of other perils. Coverage may be provided for both the direct loss, that is the actual loss represented by the destruction of the asset, and indirect loss, defined as the loss of income and/or extra expenses caused by the loss of use of the asset protected. Originally, only fire was an insured peril, but the number of perils insured against has gradually been expanded. Business may therefore purchase fire insurance contracts covering their building and its contents to both the perils of fire and lightning. The standard fire policy promises in its insuring clause to indemnify the insured for direct loss by fire, lightning, and by removal from premises endangered by the perils insured against. Insurers, however, may offer protection against a very great number of perils other than fire and lightning by extending the contract in relation to the interest of the insured through additional premium payment. For additional premium, the standard fire policy may be extended to cover any of the following perils: windstorm, explosion, damage by aircraft, damage by vehicle, flood, earthquake, fire and shock, bursting of pipes and water damage, etc. Not all fires are covered under the fire insurance contract, but the exclusions are few. 1. Fires caused by war. 2. Fires intentionally set by public authorities, and 3. Fires set intentionally by the insured. Policy format. Most of the first page of the standard fire policy is a declaration section in which is printed such information as the insured's name and address, the policy inception and expiration dates, the description and location of the property covered, the perils insured against, the amount of insurance applicable to each peril, and the code numbers of the forms and endorsements that are attached. The standard fire policy plus the descriptive form may be modified by one of more other forms or endorsements. These other forms may add, for example, business interruption insurance or extra expense insurance. Endorsements may increase or decrease the coverage. For example, they may add additional perils or exclude some parts of a covered building, such as the foundations. The first page also contains a brief insuring agreement that states the insurer's basic promise. The second page describes such matters as perils not included, uninsurable and accepted, property cancellation, and requirements in case a loss occurs. Types of policies. There are different types of fire policies. Some of the important policies include the following. 1. Valued policy. This is a policy where the value of the property to be insured against fire and allied perils is determined at the time the policy is issued. Undervalued policy, also referred to as ordinary fire insurance policy. The insurer pays the total value of damaged property, irrespective of the market value of the property at the time of destruction or loss. 2. Valuable automatic reporting policy. Under this policy, the indemnity to be paid by the insurer is to be determined at the time of the loss or after the loss has taken place. This policy is often used for properties where their value cannot be accurately determined at the inception of the contract, example, a building in process. 3. Floating policy. Under this policy, the insurer covers the interest of the insured on assets in different locations. Comprehensive policy. This form of fire insurance policy gives full protection, not only against the risk of fire but all related perils such as riot, theft, damage by vehicles, animals or articles from the air, including aircraft and the like. Rating. The rate of any given policy of protection varies in relation to the nature of the property, location, type of perils insured against, the actual cash value of the property, duration of the policy, and other similar factors that will have a bearing impact on the risk to be assumed by the insurer. In general, after consideration of such factors, fire insurance basic rates are expressed in terms of cents per 100 BER value for a base of 1 year. In other words, the rules of percentages is used in the computation of the premium rates. To illustrate, assume that a property valued at 80,000 BER was insured at 60 cents per 100 for a protection of 1 year. The premium required can be computed as follows. Value of the property. Premium equals X protection rate. 100. BER 80,000 equals by 0.60. 100 equals BER 480. Premium for 1 year. Once the premium for 1 year is determined, it can be extended for any number of years as required by multiplying the annual rate and the long-term rate that can be determined by the company, as in case of the mortality rate for different stages of age. To illustrate, let us assume that the long-term rates for a given insurer are determined as follows. Term long-term rates. 2 years 1.85 times the annual rate. 3 inches 2.70 inches. 4 inches 3.50 inches. 5 inches 4.40 inches. Further, if we assume that there is an insured who wants to have an insurance policy for his 20,000 BER worth at the annual rate of 25 cents per 100 BER value, we can determine the premium required for 1 year or 3 years policy as follows. Bridge. 20,000. Premium for 1 year equals X 0.25 equals bridge. 50. 100. Premium for 3 years equals bridge. 50 x 2.70 equals bridge. 135. Similarly, a house valued at 24,000 bridge is insured annually for 80% of its value at 36 cents per 100 BER. The premium for 4 years can be computed as follows. Premium base insurable value is bridge. 24,000 x 80 equals bridge. 19,200. 100. Annual premium equals 19,200 x 0.36 equals bridge 69.12. 100. Premium for 4 years equals bridge. 69.12 by 3.5 equals bridge. 241.92. Settlement of losses. Settlement of loss depends on the type of policy carried or the agreement made at the inception of the policy between the insurer and the insured. For illustration, consider the following cases. 1. Settlement under ordinary fire insurance policy, OFIP, or standard fire insurance policy. Here the insurer pays the full amount of the loss up to the face value of the policy. Example. A house that was valued at bridge 30,000 was insured for bridge 25,000. If a loss of 20,000 BER, 25,000 BER and 30,000 BER has occurred, the insurer will pay 20,000 BER, 25,000 BER and 25,000 BER respectively. 2. Settlement of loss from more than one insurer. When the insured has carried insurance from more than one insurer and a loss has occurred, the different insurers would contribute to the loss on pro rata basis up to the amount of the face value of the policy on the amount of the actual loss. Example. An apartment building was insured under the following, with insurer A for bridge 50,000 and with insurer B for bridge 30,000. Assuming a loss of bridge 32,000 has occurred, the two insurers would contribute to the loss as follows. A equals bridge 50,000 x bridge 32,000 equals bridge 20,000 bridge 80,000. B equals bridge 30,000 x bridge 32,000 equals bridge 12,000 bridge 80,000. Total indemnity for the insured equals bridge 32,000. 3. Settlement under coinsurance fire policy. When the policy is carried on the basis of coinsurance clause, the insurer will have the right to make the insured pay part of the loss if he is underinsured. Example. Assume that an insured 6 months ago purchased bridge 100,000 of insurance on property with an actual cash value of bridge 150,000. Assume further that the insurance contract Contained an 80% co-insurance clause. If the property is worth 200,000 BER today, the amount the insurer would pay toward a loss today would be computed as follows. Amount of insurance carried. Indemnity equals X loss. Co-insurance % value at time of loss, but not to exceed the loss or the amount of insurance, or bridge. 100,000. X loss. 0.80 bridge. 200,000 equals 5/8 X loss. If the loss were bridge 80,000, the insurer would pay bridge 50,000. If the loss were bridge 170,000, the insurer would pay bridge 100,000, the amount of insurance. The answer will always be the amount of insurance when the loss exceeds the required insurance. The term co-insurance has different meanings in insurance. In health insurance, the co-insurance clause is simply a straight, deductible, expressed as a percentage. Its purpose in health is to make the insured bear a given proportion, say 20%, of every loss, because it has been found through experience that without such a control, the charges for doctors and other medical services tend to be greatly enlarged, thus increasing the premium to a prohibitive level. The insured that must personally bear a substantial share of the loss is less inclined to be extravagant in this regard. In fire insurance, the co-insurance clause is a device to make the insured bear a portion of every loss only when underinsured. Check your progress. 4.1. Explain the main fire insurance not covered under the fire insurance contract policies. 4.2.2. Marine insurance. Marine insurance is designed to protect against financial loss resulting from damage to, or destruction of owned property, due to the perils primarily connected with transportation. It is a contract of transport insurance whereby the insurer undertakes to indemnify the insured in the manner and to the extent thereby agreed, against losses and damages involved in being transported. In consideration of the payment of a certain sum called the premium, the insurer underwriter agrees to indemnify the insured, the client, against loss or damage caused by certain specified perils, termed maritime perils. The marine cargo policies of Ethiopian Insurance Corporation are internationally accepted, worded and standardized insurance policies. Accordingly, the coverage it affords is to indemnify the insuring public as per the terms, conditions, warranties, and exceptions of the policy in respect of loss of or damage to the cargo insured mainly resulting from maritime perils, heavy weather, stranding, collision, etc., or inland transit accident, such as collision, overturning of the carrying conveyance, explosion, fire, theft, non-delivery of the goods, etc. Marine insurance is divided into two classes: ocean marine and inland marine. Ocean marine insurance. Contracts concerned primarily with water transportation are considered to be ocean marine insurance. For a considerable time, ocean marine insurance was the only kind of modern insurance. Insurance has been developed and has attained a high degree of refinement in modern day commerce. As world trade grew and values at risk became larger, the need for coverage became more apparent. Larger ships and more refined instruments of navigation made long voyages possible, and with this development, insurance protection was looked upon as almost a necessity. Major types of coverage. The four chief interests to be insured in an ocean voyage are: 1. The vessel, or the hull. 2. The cargo. 3. The shipping revenue or freight received by the ship owners. 4. Legal liability for proved negligence. If a peril of the sea causes the sinking of a ship in deep water, one or more of these losses can result. However, each of these potential losses can be covered under various insurance policies. Hull policies. Policies covering the vessel itself or hull insurance are written in several different ways. The policy may cover the ship only during a given period of time, usually not to exceed 1 year. The insurance is commonly subject to geographical limits. If the ship is laid up in port for an extended period of time, the contract may be written at a reduced premium under the condition that the ships remain in port. The contract may cover a builder's risk while the vessel is constructed. Cargo policies. Contracts insuring cargo against various types of loss may be written to cover only during a specified voyage, as in the case of a hull contract, or on an open basis. Under the open contract, there is no termination date, but either party may cancel upon giving 30 days written notice to the other. Otherwise, the insurance is continuous. All shipments, both incoming and outgoing, are automatically covered. The shipper reports to the insurer at regular intervals as to the values shipped or received during the previous period. Cargo policies written on a voyage basis cover that single voyage, but open policies usually cover all shipments made on and after a certain date. If an open policy is cancelled, the coverage continues on shipments made prior to the cancellation date. Freight coverage. The money paid for the transportation of the goods, known as freight, is an insurable interest. Because in the event that freight charges are not paid, someone has lost income with which to reimburse expenses incurred in preparation for a voyage. The earning of freight by the hull owner is dependent on the delivery of cargo unless this is altered by contractual agreements between the parties. If a ship sinks, the freight is lost and the vessel owner loses the expenses incurred plus the expected profit on the venture. The carrier's right to earn freight may be defeated by the occurrence of losses due to perils ordinarily insured against in an ocean marine insurance policy. The hull may be damaged so that it is uneconomical to complete the voyage, or the cargo may be destroyed, in which case, of course, it cannot be delivered. Also, the owner of cargo has an interest in freight, arising from the obligation to pay transportation charges. Freight insurance is normally made a part of the regular hull or cargo coverage instead of being written as a separate contract. Legal liability for proved negligence. In ocean marine insurance policies, the hull owner is protected against third-party liability claims that arise from collisions. Collision loss to the hull itself is included in the peril clause as one of the perils of the sea. The liability insurance is intended to give protection in case the ship owner is held liable for negligent operation of the vessel which is the proximate cause of damage to certain property of others. The vessel owner or agent of that owner who fails to exercise the proper degree of care in the operation of the ship may be legally liable for damage to the other ship and for loss of freight revenues. Loss settlement. If the cargo is totally destroyed, the insurer must pay the face value of the policy. If the cargo is only partially damaged, the insured and the insurer must agree on the percentage of damage. If they cannot agree, the damaged cargo is to be sold for the account of the owner and the amount received compared with what would have been received had the cargo been in sound condition. In either case, the liability of the insurer is determined by applying the percentage of damage to the amount of insurance. For example, assume that a cargo insured for 4,000 birr could have been sold for 6,000 birr in sound condition but are worth only 4,500 birr in damaged condition. Since the damage is 25%, the insurer must be paid 25% of 4,000 birr. Note that if the amount of insurance is less than the value of the cargo in sound condition, the amount of the insurance payment is equal to the amount under a 100% co-insurance clause. Inland marine insurance. Inland marine cargo insurance covers shipments primarily by land or by air. Although the trucker, railroad, or airline may be a common carrier with the extensive liability, bald liability exposures, the shipper may still be interested in cargo insurance because 1. It is usually more convenient to collect from an insurer than a carrier. 2. A common carrier is not responsible for perils such as an act of war, exercise of public authority, or inherent defects in the cargo. No one cargo insurance contract exists. Instead, different insurers may issue different contracts, and a given insurer will tailor the contract to the insured's needs. A convenient way to classify the contracts is according to the type of transportation covered. One or more of the following modes of transportation may be covered: railroad, motor truck, or air. Shipments by mail are covered under separate first-class mail, parcel port, or registered mill insurance. Check your progress. 4.2. List the 4 chief interests to be insured in an ocean voyage. 4.2.3. Fidelity Guarantee Insurance. Fidelity Guarantee Insurance indemnifies an employer for any loss suffered at the hands of dishonest employees. It provides guarantee against loss through the dishonesty or incapacity of individuals who are trusted with money or other property and who violate this trust. Cashiers and others who handle money, and other persons employed in positions of trust, are frequently required by their employers to provide security as protection against their personal dishonesty, usually in the form of fidelity guarantee policy. The policy indemnifies the employer against losses from the dishonesty of his employees. The employer himself often takes out the policy. He may insure a number of employees either individually or in a group basis under a variety of policies. Unlike other policies, fidelity guarantee policies specify a time limit to discover the loss and report it to the insurer after the resignation, dismissal, retirement, or death of the employee in question. Hence, while the insurer undertakes to make the insured's financial losses lighter, it is also a requirement that the insured should 1. Inform the insurer of such fraudulent act immediately upon discovery. 2. Either obtain admission of fraud or take appropriate legal action to establish fraud. And 3. Cooperate with the insurer to bring the defaulter before the court of law. In addition, before accepting the risk, the insurer considers employer's type of establishment, methods of selecting employees, working conditions, emoluments and benefits in relation to the responsibility assigned, supervision and control measures effectiveness. 4.2.4. Theft insurance. Although theft is generally one of the perils covered under an all-risks policy, the contract usually excludes or limits the amount of protection on certain types of property, such as money, that is highly susceptible to theft losses. Theft insurance protects a business against losses by burglary, robbery, or some other form of theft by persons other than employees. Fidelity guarantee insurance or dishonesty insurance covers losses caused by dishonest acts of employees. Burglary is the act of unauthorized entry, with criminal intentions into any building or residence. It is the unlawful taking of property from within premises closed for business, entry to which has been obtained by force. There must be visible marks of the forcible entry. Thus, if a customer hides in a store until after closing hours, or enters by an unlocked door, steals some goods, and leaves without having to force a door or a window, the definition of burglary is not met under a burglary policy. Robbery, on the other hand, is defined to mean the unlawful taking of property from another person by force, by threat of force, or by violence. Personal contract is the key to understanding the basic characteristic of the robbery peril. However, if a burglar enters a premise and steals the wallet of a sleeping night guard, this crime is not one of robbery because there was no violence or threat thereof. The person robbed must be cognizant of this fact. On the other hand, if the thief knocks out or kills the guard and then robs the guard or the owner, the crime would be classed as robbery. Robbery thus means the forcible taking of property from a messenger or a custodian. According to the EIC burglary policy, it does not cover losses or theft committed by 1. Members of the insured's household. 2. The insured himself or his assignee. 3. Theft connected with war, declared or undeclared, or any kind of population uprising, or 4. Theft of valuables including documents and works of art unless agreed pre-hand. In addition, failure to disclose material facts at the time of writing the policy will also make any theft claims null and void. 4.3. Liability insurance. Liability insurance contracts obligate the insurer to pay amounts the insured becomes legally obligated to pay as a result of covered injury to others. In addition, the insurer is obligated to provide legal defense services for the insured against liability claims to which the coverage applies. Basis of legal liability. Each person has certain legal rights. A legal wrong is a violation of a person's legal rights, or a failure to perform a legal duty owed to a certain person or to society as a whole. The peril of legal liability arises out of the general rule of law that people are responsible for any loss, injury they cause another to suffer. The law creates three categories for describing situations in which one person injures another. Torts are civil wrongs. Breaches of contracts. This can occur when one party fails to keep a legally binding agreement. Criminal acts. These actions are forbidden by law and can result in fines, imprisonment, or other penalties. Categories of liability insurance. One of the major exposures facing every business is the possibility of legal liability, the chance that the firm or its owners may be sued for bodily injury or property damage which arises out of the activities of the business. The liability exposures arising from business operations are both numerous and varied, and for the business firm as for the individual, there is virtually no calculable limit to the losses that can arise from legal liability. The sources from which liability can result multiplies with the complexity of the business, and as a result, the field of commercial liability is significantly more complicated than the field of liability coverages for the individual. Business general liability insurance. Given the wide scope of most business activities, the possibility of a firm is sued is great. We can categorize business general liability exposures as follows: direct liability, vicarious liability, contractual liability. Direct liability arises out of the firm's own actions. Most of these exposures fall into the following three categories: premises and operations. Many lawsuits result from the ownership, use, and maintenance of business building and grounds. For example, assume an employee neglects to clean an oil spill from a floor, resulting in a patron slipping and being injured. The patron then sues the firm, alleging the injury resulted from the firm's negligence. Products liability. Products liability refers to the legal liability of manufacturers, wholesalers, or retailers of products to persons who incur bodily injuries or property damage from a product. A manufacturer or seller of a product can be held liable as a result of improper product design, improper assembly of the product, failure to warn of inherently dangerous characteristics, and deceptive advertising. Completed operations. Service firms like contractors and plumbers are sued when plaintiffs claim their work was improperly done or left undone, resulting in an injury. Vicarious liability, also called indirect liability, most often arises when a firm hires an independent subcontractor. If the independent contractor injures a third party, the firm hiring the contractor may find itself named in the lawsuit along with the independent contractor. The plaintiff would claim the firm was negligent in hiring, informing, or supervising the contractor. Contractual liability arises from contractual agreements in which it is stated that some losses, if they occur, are to be borne by specific parties. Business liability umbrella policy. As the risk manager contemplates worst-case possibilities. Surety, the possibility of being sued successfully for an amount in excess of available policy. Comprehensive general liability policy. Limits must come to thought. To deal with this possibility, a commercial umbrella policy can be purchased. This policy provides coverage after underlying liability policies have been exhausted. In this case, the umbrella policy is called excess insurance, because the umbrella policy pays only or losses in excess of the underlying limits. For example, assume the General Bean Factory is held responsible for injuring Otto Zenu, a visiting can salesperson. The jury returns BR 50,000 verdict in favor of Otto Zenu. General Bean's comprehensive general liability policy has a coverage limit of BR 10,000 for such bodily injuries. If General Bean has a BR 50,000 liability umbrella, it would pay BR 40,000 of the award, which, along with the comprehensive general liability policy coverage of BR 10,000, would fully compensate Otto Zenu. Professional liability insurance. The term professional refers to a person with special skills, education, or knowledge compensated to provide a service to the public. Professional liability insurance, sometimes called malpractice insurance or errors and omissions. Insurance typically commits an insurer to pay all sums that the insured becomes legally obligated to pay as damages resulting from providing or failing to provide professional services. Illustrative of professional liability insurance contracts are policies issued to druggists, hospitals, physicians, surgeons, dentists, lawyers, accountants, members of board of directors, and insurance agents and brokers. Under these policies, the insurer agrees to pay all sums that the insured becomes legally obligated to pay because of damages arising out of malpractice, error, or mistakes in rendering or failing to render the appropriate professional services. 4.3.1. Automobile insurance. Most automobile insurance contracts are schedule contracts that permit the insured to purchase both property and liability insurance under one policy. The contract can be divided, however, into two separate contracts, one providing insurance against physical damage to automobiles and the Other protecting against potential liability arising out of the ownership or use of an automobile. The object of automobile insurance is to indemnify the insured against accidental loss or damage to his auto and/or his liability at law for bodily injury or material damage caused by the use of the motor vehicle, subject to the terms and conditions and to the cover granted. There are two main types of insurance covers in both motor commercial and motor private insurance, viz. Comprehensive cover and third-party cover. A comprehensive cover provides protection against a wide range of contingencies. It includes indemnity in respect of the insured's legal liability for death or bodily injury or damage caused to the property of third parties arising out of the insured's vehicle. The policy also indemnifies the insured in respect of all damages to the vehicle caused by an accidental, external physical means as a result of collision, overturning, fire, self-ignition, lightning, explosion, and burglary. The policy excludes, among other things, the following: consequential loss sustained by the insured, wear and tear, depreciation of motor vehicle, mechanical or electrical breakdown of failure of any part of a motor vehicle, death of or injury to members of insured family or his employees, damage to property of the insured or held by him in trust or in custody. B. Third-party cover. There are two parties involved in an insurance contract, the insurer and the insured. Accordingly, any other person who may become linked in some way with the insurance is regarded as third party. A third-party only policy covers the insured's legal liability, i.e., property damage, death, and injury towards other people in the event of an accident arising out of the use of a motor vehicle. A third-party policy may be extended to include at an additional premium the policyholder's vehicle against the risks of fire and theft as follows: third party, fire and theft, third party and fire, third party and theft. The basic cover guaranteed by the Ethiopian Insurance Corporation's policies can be extended to cover additional risks at an additional premium. Classification of risks. There are various categories of automobile risks and a distinction is made in accordance with the use and type of the vehicles. The main classifications are as follows. 1. Private vehicles. A motor vehicle used solely for private, social, domestic, pleasure, professional purpose or business calls of the insured purposes are classified as private vehicles and are insured under the private motor vehicles policy. The term private purposes does not include use for hiring, racing, and carriage of goods in connection with any trade or business. 2. Commercial vehicles. A wide range of vehicles which carry goods and passengers are classified under this heading and different rates of premium are applied depending on their use and type. 4.3.2. Aviation insurance. Aviation insurance is a comparatively recent phenomenon that has been developing with the development of passenger planes, particularly jumbo jets. The overall increase in the number of different passenger planes and the increase in their value called for aviation insurance. Aviation insurance is an insurance that provides protection against loss of or damage to the different types of passenger and cargo planes, and associated losses. Like automobile insurance, aviation insurance includes both property insurance, on the planes, and liability insurance. Types of policies. The most common types of policies under aviation insurance are: 1. Aircraft comprehensive policy. 2. Freight liability policy, which includes airmail liability policy. Aircraft comprehensive policy. This policy covers against three types of potential losses. A. Accidental damage to the aircraft, where protection is provided for damage to the aircraft by accidents except those that are specifically excluded on the policy. B. Third-party legal liability, where the insurer assumes the responsibility to indemnify the insured for death or bodily injuries to third parties excluding passengers. And ground damage. C. Legal liability of the insured in respect of death of or bodily injuries to passengers. Passengers, baggage and personal effects, which are registered, are also covered by the insurance. 4.3.4. Public liability insurance. Public liability insurance was developed with employees' liability insurance. Once, public opinion had accepted the morality of being able to insure one's liability, and the availability of such insurance became known. the business grew rapidly. The policy provides compensation for legal liability for death, injury, or disease to people other than employees, which should be covered by employers. Liability policy. Public liability insurance provides what is popularly termed third-party cover. It indemnifies the insured in respect of his legal liability for accidents to members of the public, or for damage to their property, occurring in circumstances set out in the policy. Under public liability insurance, policies are available to cover liabilities attaching to a. Pedal cyclists. B. Private individuals. The so-called personal liability policy is available to protect private persons from claims arising due to injury caused by such things as polished floor, a loose roof tile, or by pet animal. A pedestrian, for example, can incur heavy liabilities by causing a serious road accident. C. Product liability. Liability arising out of defects of goods produced or sold. D. Professional men such as doctors, dentists, solicitors, and bankers may take out policies to protect themselves from claims arising out of negligence or mistake committed in the exercise of their professional duties. It should be noted that this form of cover might include or be included with other risks. For example, a householder's policy covering loss or damage to the building and/or contents can be extended to cover the personal liability of the owner and his family towards the public. Whereas, liability arising from the use of motor vehicles is always excluded, and must be covered by a separate motor policy. Chapter summary. Non-life insurance consists of property and liability insurance that are designed to provide protection against losses resulting from damage to or loss of property and losses resulting from legal liability. Property may be exposed to a wide range of perils: fire, theft, perils of the sea, and damage by persons, whether accidental or carelessness. Fire insurance is designed to indemnify the insured for loss of, or damage to, buildings and personal property by fire, lighting, windstorm, hail, explosion, and a vast array of other perils. In general, after consideration of such factors, fire insurance basic rates are expressed in terms of cents per 100 BER value for a base of 1 year. Marine insurance is designed to protect against financial loss resulting from damage to, or destruction of owned property, due to the perils primarily connected with transportation. The 4 chief interests to be insured in an ocean voyage are: 1. The vessel, or the hull; 2. The cargo; 3. the shipping revenue or freight received by the ship owners; and 4. Legal liability for proved negligence. Theft insurance protects a business against losses by burglary, robbery, or some other form of theft by persons other than employees. Fidelity guarantee insurance or dishonesty. Insurance covers losses caused by dishonest acts of employees. Liability insurance contracts obligate the insurer to pay amounts the insured becomes legally obligated to pay as a result of covered injury to others. In addition, the insurer is obligated to provide legal defense services for the insured against liability claims to which the coverage applies. We can categorize business general liability exposures as direct liability, vicarious liability, and contractual liability. Aviation insurance is a comparatively recent phenomenon that has been developing with the development of passenger planes, particularly jumbo jets. The most common types of policies under aviation insurance are: 1. Aircraft comprehensive policy, and 2. Freight liability policy, which includes airmail liability policy. Public liability insurance was developed with employees' liability insurance. Once public opinion had accepted the morality of being able to insure one's liability, and the availability of such insurance became known, the business grew rapidly.